Hi, this is SABARI from SABARI Securities. Welcome to Option Unlocking Series 1, Chapter 4. In today's episode, we will understand what is option payoff chart. And before we see that, we have few basic concepts that we need to see first. The first is margin money. Now, margin money is the deposit paid by an option seller to the exchange so that the broker can cover their positions from incurring continuous loss. So we know an option seller will have limited profit and unlimited loss, right? So in case the position goes into an unlimited loss, then the broker will come out with two options, either requesting the option seller to transfer additional capital or the position will be auto squared off, right? Margin money will be different for each option. Now, let's see it on the screen. This is the Zerodha margin calculator page where we can check the margin money for different options. We will choose Nifty monthly expiry. Here you go. And we will just select the strike price, call option 22,000. And one lot of Nifty is 50 shares and sell. And here you see on the right side, the margin money is around 95,535. So roughly it is around 1 lakh, right? So likewise, you can check the margin money for different stock option as well as index option. So the next concept is MTM, which is mark to market. Now, MTM is the daily settlement of profit and loss of an option position. Let's say, for example, an option buyer buys a call option of SBI at the 35 rupees premium and the SBI is trading at 640, assuming the price of the SBI will move up. Let's say on the end of day 1, the premium value closed at 40 rupees. Day 2, it closed at 30 and day 3, it closed at 50 rupees. Let's say on the end of the day 3, he squared off the position. Now, at the end of day 1, the premium bought was for 35. At the end of day 1, it was 40. So the profits made is 5 rupees. It should be credited to the option buyer's account. On end of day 2, there is a net loss of 5 rupees and that will be debited from the option buyer's account on end of day 2. On end of day 3, it is plus 15 and again it will be credited back to the account. So the net profit what is made is end of the day is 15 rupees, right, per lot. Now in option, if you look at the broker's screen, there will be MTM, right? That will reflect what is the daily profit and loss of the option position taken by an option buyer or an option seller. Now, at any given point of time, if you want to look at the overall net profit or loss of the option position, you can always refer to the option payoff chart, which we will discuss shortly. The next concept is hedging. Hedging in option is protecting your capital from volatile price movements that would end up in generating huge loss, right? So let's say in our case, option seller will have limited profit and unlimited loss, correct? An option buyer has a limited loss but unlimited profit. Now, when an option seller takes a sell position which generates a limited loss scenario, it is always risky, right? So, an option seller will always hedge his position with an alternate option which will generate unlimited profit, right? So, in this case, for every sell, there needs to be maintained another alternate position that will generate unlimited profit. So, which will generate unlimited profit? An option buy, correct? So, for every sell, we need to maintain a buy, and that will create a hedge. This is very, very important. Just keep in mind, right? For every sell, we need to maintain a buy so that net on net, it will generate a limited profit or limited loss, right? So finally, we will discuss about option payoff chart. Option payoff chart is the profit and loss chart that shows the risk reward profile of an option strategy in real time, right? So if you look at the option payoff chart, we have x-axis, we have y-axis. So y-axis always represents the profit and loss. So profit and loss, and x-axis represents the stock price or index price. In case of, let's say, SBI, let's say if the current market price is 640, 630, 620, or 650, 660, 670, right? So whatever option strategy we create, it will be plotted in the middle and it will show us what is the risk reward profile of this option strategy, which we will discuss shortly. Option payoff chart provides the following details of an option strategy. It shows what is the capital required to create option strategy, shows what is the maximum profit, what is the maximum loss, what is the net profit, which is the running profit, and it will show what is the risk reward ratio between max profit and max loss. And finally, it will also show what is the break even. Now, break even is very important because break even is a point where an option buyer or a seller will make no profit and no loss, right? Now, let's take an example. So we have an option buyer. So he buys a Nifty 21,650 call option. C is call and E is European standard, right? Let's say it is trading at a premium of 50 rupees, for example. Okay, this is the option position. Let's see how the payoff works. 0. So it is a profit. This is a loss. And the center line is the Nifty closing price, which is 21,666. So here it will have 21,600 and 21,550, 21,700, 21,750. Right. What is the capital required? Let's say he buys one lot of Nifty. He buys one lot of Nifty. In options, when we deal with quantity, it is always a lot size, right? So one lot of Nifty is 50 shares. So capital required is, let's say, one lot is 50 shares into the premium, which is 2,500. So this is the premium an option buyer has to pay for this option position. Now, what is the maximum profit here? It is unlimited, right? An option buyer will always generate unlimited profit. Right? What is the max loss? Let's say his view goes wrong. The maximum loss he can make is the 50 rupees premium what he paid, right? That can become 0, right, on the day of expiry. So the max loss also will be 2,500. Now, what is the break even? So the break even is, okay, the formula to calculate the break even is, please note down. For a call option, it is always strike price plus premium. Right? For a put option, it is always a strike price minus premium. That's very important. Right? So in our case, the strike price is 21,650 plus the premium paid is 50 rupees. So the break even will be 21,700, which means now the graph will be plotted like this. Right. So today the market is closed at 21,666 and the break even point is 21,700. So let's say from tomorrow the Nifty starts to move higher, the premium also will generate immediate profit. Let's say on the day of expiry, right? If Nifty closes exactly at 21,700, then this position will not generate a profit or a loss. If it closes above 21,700, then that will generate unlimited profit. Okay. But if it closes below 21,700, that will generate a minimum loss, right? So the break even is very, very important. So fair enough. I think this is a simple calculation. Now I will show you on the screen how to create this option payoff diagram using Opstra Define Edge. This is the Opstra Define Edge website where you can create option strategies. Now we are in the portfolio tab, strategy builder, and can choose Nifty and options, set the expiry date to 25th Jan. And here, let me choose at the money option. So spot is 21,680. So I'll choose 21,600. And in this example, I'll buy a call option with a bullish view. So call option, buy, and lot size is 1, which is 50 shares. Add position. Now this is the payoff graph. And on the left side, coming from the bottom, estimated margin premium, which is the capital required to take the strategy, which is 9,540. As an option buyer, the capital is the premium that you pay, right? Here, the premium is 190.8 into 50 shares, which is 9,540. So what is the maximum profit as an option buyer? It is unlimited. And maximum loss 9,540. Now for calculating the break even for a call option, it is strike price plus the premium. So the strike price what we chose is 21,600 and the premium is 191. So it will be 21,791, right? So which means on the day of expiry, if Nifty closes exactly at the break-even point, which is 21,791, there will be no profit or no loss. If it closes anywhere above 21,791, then you will end up in having an unlimited profit. Now, if it closes anywhere below 21,791, it will create a limited loss. That is a max loss. Clear? Now let me sell a call option with a bearish view and see how it works. Same options. 25th Jan is the expiry date. Again, at the money option, 21,600. Call option. Instead of buy, this time I'll be selling and one lot of Nifty at position. Now this is the payoff on the right side. On the left side, as we already discussed, for every option sell, the exchange collects a margin money, right? So we sold one lot of Nifty and the margin money, that is the capital required, is 1,15,885. Now what is the maximum profit as an option seller? Whatever premium that we collected will be the maximum profit. In this case, the premium collected is 190.8, right? So the max the premium can fall down is 0. So that will be our maximum profit, 190.8 into one lot, which is 50 shares, which is 9,540. An option seller will always have an unlimited loss, right? Undefined loss. Now, in order to calculate the break even, it is 0 to 21,790. So for a call option, again, strike price plus the premium. So 21,600 plus 190.8, which is 21,790, which means if Nifty closes exactly at 21,790, it is going to be a break even with no profit, no loss. If it closes anywhere above 21,790, that will end up in having an unlimited loss. And if it closes anywhere below 21,790, that will generate the maximum profit. Clear? Now, let me try to buy a put option and show how the payoff works. So Nifty options expiry is 25th Jan and 21,600, which is at the money. And here I'm going to choose put option, buy one lot at position. Now this is the payoff, and since it is an option buying with a bearish view, I have bought a put option and the premium paid is 110 rupees. So the capital required is 110 into 50, which is 5,505 is the maximum capital required to take this position. Since it is an option buying, maximum profit is unlimited and maximum loss is the premium paid, which is 5,505. Now the important point is the break even. Now for put option, the formula is strike price minus the premium, correct? So 21,600 minus 110, which is 21,489. So 0 to 21,489, which means if Nifty closes exactly at 21,489 on the day of expiry, it will generate no profit, no loss. If it closes anywhere above 21,489 on the day of expiry, it will generate unlimited profit. And if it closes anywhere below 21,489 on the day of expiry, it will generate the maximum loss. Hope this is very clear. And with this approach, we will be able to create multiple option strategies using Opstra that will enable us to generate monthly income, which we will be seeing in the Series 2 and Series 3. So with this, we have come to end of Series 1. I request all of you to revise all these 4 chapters so that it becomes very easy for you to understand all the concepts that we will be seeing in series 2.